One question that's paramount on every mutual fund investor is dividend or growth. It gains significance in light of the new taxation rules that have come up in this budget. In today's Investors Hangout, we will tackle these two questions. This episode is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, we welcome you.
Thank you.
And the question that's paramount that I said is growth or dividend? And particularly so in light of the LTCG and the DDT that on equity funds that we're talking about these days. What should an investor be doing? Investing in dividend and dividend reinvestment plans?
It always made sense when you were investing in equity because it is a gradual accumulation vehicle. One should not have been investing in dividend plans or dividend reinvestment plans. But investors, for some historic reason, one is that investors feel happy when they get some periodic dividend. They think that their investment is working, it's performing. If you get some dividend, that's one. And then that is a myth around it. And there was absolutely no penalization. There was no penalty for investors choosing a dividend plan. Because the dividend was completely tax-free. So was long-term capital gains tax if you held an investment. No longer. It's a very important question, and it is a very important issue which every investor should address it right away. Because today, investing in dividend option or investing in the dividend distribution, reinvestment option, it will hurt your interest. Because the moment you get the dividend, even if you don't need the money will get reduced by 10%. So your investment is in equity for many, many years. It's a long-term investment. You are investing in equity for 10 years, 15 years, 5 years, whatever be the period. And any periodic dividend that you get, that will get reduced by 10% because 10% dividend distribution tax is applicable on all dividend payments, which was not so far. It will hurt your interest. Your dividend payout gets reduced. So investors should, work hard to make sure that, they are not investing in the dividend plans. They are not investing in the dividend distribution plan. They should be investing in the growth plan. And you should take your money out because these are open-end funds. You can choose the time and amount of money that you need, how much money you need, and when do you want it. You can take it out anytime. And when you withdraw partially from a mutual fund, it is very convenient. One is that you can actually do a programmed instructions. You can give a standing instruction that at a certain, that is called, it is a reverse of SIP, which is systematic withdrawal plan. But even if it is not systematic, even if it is ad hoc, even if it is less periodic, even if it is an annual thing, or once in a while you need a part of your money, you don't need it in the form of a dividend. You should be taking that money when you need it. And you should take the amount of money which you think either you need it, or you can adjust the amount that you need based on the performance of your investment. Because dividend, many times you used to get a part of your money which may not have performed well. If you invest a lakh of rupees, and if the fund company decides to give you a 5,000 rupee dividend, then your capital gets reduced to 95,000 rupees. Today you can actually choose when your funds are doing well, when they are performing, and if you need the money, take it out. So move your money, all your money in equity funds or balanced funds from the dividend distribution, dividend plans or the dividend reinvestment plan immediately. And this will be complicated. It will, because you will have to redeem your investment. It cannot be done without by just giving an instruction. You can fill a form, give the fund company an instruction, it will move the money, but it will have an implication. Your units will be redeemed and they will be invested in the growth plans.
Okay. So what Dhirendra is saying is that equity is a long-term investment and you should let your money make the most of compounding, right? By keeping it invested through the growth option.
Yes.
Right? And instead of partially getting it back through dividend. And he explained to you how your money reduces. What about, now this is about the equity funds, what about the debt funds? Should one go with dividend option or growth option even here?
One is that there is absolutely no change in this budget on the tax front about debt fund. There is a status quo. It exists the way it was. But even in debt funds, the growth plan works better. It is more rewarding because the dividend distribution tax on debt fund is nearly 20, it's about 29% for individuals. It's 34% for companies. So 29% is comparable to the highest tax bracket. So if you're in the lower tax bracket, it is better to take it in the form of, even because your alternative is that if you invest in a debt fund in the growth option, you take some return in the form of capital gains. It will be added to your income. And if you are falling in the 5% tax rate or 10% tax rate or 20% tax rate, it is lower than the dividend distribution tax.
Right.
So the dividend plan there also will hurt, will actually be more than the general tax liability. Only in the highest tax bracket, there is a very marginal tax differentiation, 1% less, which is insignificant. So I would suggest that, even debt in fixed income investors should always invest in, even while investing in debt fund, you should invest in the growth option. There is another advantage of it. If you hold it for 3 years, indexation and 20% tax rate actually reduces your tax bill substantially. Because in case of debt fund, the indexation means that the money adjusted for inflation for 3-year holdings and more. So the remaining returns, the remaining appreciation will be so insignificant that and paying 20% of those gains is much less. So I would suggest that the growth plans works better even in case of debt fund. Long time ago there was a differential, there was a tax arbitrage. The dividend distribution tax wasn't there for individuals, it was there for companies, and then it was substantially lower. It was 10%, initially it was 7.5% or so, and 10%, but today that differential is gone. So mutual funds, choose the growth option. That's the best way to go about it.
Okay. And what about those who need regular income from their fund investments? Would you recommend dividend option to them?
No, even for them it doesn't make sense, because the mutual fund as a vehicle, the open-end funds, you can take a part of your money back anytime. So the withdrawal plans actually work better from a taxation point of view, because let me give you an example.
Right.
If you invest 1 crore of rupees, and if you are taking 1 lakh, I'm just giving this large number for
it's an example.
And for ease of calculation.
Yeah. Okay.
If you invest 1 crore of rupees, and if you decide to withdraw 1 lakh rupees every month, and your 1 crore rupee increases to 1 crore 1 lakh rupees, and you decide to withdraw 1 lakh rupees next month, you are not taking only the appreciation, you are actually redeeming a part of your units. And so your 1 crore remains constant, and you have taken 1 lakh rupees, assuming that this was done with a bank deposit. You take all this 1 lakh rupees, that the interest that has accrued on your investment, it will be completely taxable. Here, your 1 lakh rupee is primarily, a substantial part of it will be actually withdrawing your capital from a taxation point of view.
Right.
So the tax incidence on this will be hardly anything. So the withdrawal plans is much more tax efficient. Tax wise, it'll look like as if you are taking a part of your capital. Your appreciation on the remaining investment remains intact. Your investment is doing okay, but the tax bill will be lower. So on top of it, you will have full control on when you need the money.
Right.
You will also have a greater control on what part of your gains you are taking out. You can also be flexible about it. And this is all done with great ease. Today you can give a standing instruction to a fund company, which is called systematic withdrawal plan. It is the reverse of SIP. You say that, okay, this much money, this much of my money should get credited to my account by redeeming my investment on a specific day of the month, and till my money remains
just
there.
Like SIP.
Just like SIP, inverse of that. It works better, it is tax efficient, and everything is in your control, and that is how it should be.
Okay. What Dhirendra is saying is, please keep it simple, go for growth option, and put in place a systematic withdrawal plan
For
if you
periodic
need
income.
Steady income stream. Okay, so this was growth or dividend we've answered for you. We go on to the Q&A part of it, and the first question is from Prakash Chand. Now he's also asked a similar question, Dhiren. I've opted for dividend option in a tax-saving mutual fund. Can I change it to growth option? If yes, will it be treated as a sale of old units and purchase of the new one?
No, first and foremost, you can't do it till the lock-in period expires, because 3-year lock-in period applies and is applied stringently.
Okay.
So you don't have a choice.
Okay.
After 3 years, you are at liberty. Maybe take your and all the change from dividend option to growth option will amount to redeeming your investment in an open-end fund, or in case of a tax-saving fund after the lock-in period will amount to redeeming your investment and investing again. If you do it in your tax-saving fund, move from dividend option to growth option after 3 years, then the new lock-in will apply once again.
Yeah.
It will be locked in, and it can well be considered as that year's tax-saving investment, but the 3-year lock-in will apply on the tax-saving fund thereafter.
Okay. And we have BK Chaturvedi asking us, under what circumstances would a dividend reinvestment option be beneficial?
Under no circumstances dividend reinvestment option can be beneficial. In fact, it is injurious, because it is dividend reinvestment.
Any which way it's going to be?
No way
injurious.
it is going. It will hurt your interest.
Okay.
I'll tell you why. In fact, dividend, there can still be logic that okay, you want to remain passive, and okay, this is the kind of tax liability, and the dividend is tax free 10%. You want the convenience, but in this case, it hurts your interest because you are not getting dividend. The dividend gets reinvested, and the dividend doesn't get reinvested fully, because the moment the fund company pays you the dividend, it has to deposit the dividend distribution tax. It gets reduced by 10%. So assuming that you have invested whatever amount and 100 rupee of dividend is paid by the fund company, only 90 rupee will get reinvested and 10 rupee will be paid as by way of dividend the dividend distribution tax. Okay. So your 10 rupee dividend doesn't get reinvested, and only 9 rupee gets reinvested. So move your money from dividend reinvestment plan. At least stop reinvesting it, and this can be done. You can choose to, because this is a non-financial transaction. You can tell a fund company that you don't want dividend reinvestment anymore. You want your dividend given to you. This is possible without any tax implication. But what I would suggest, for if it is going to be an accumulation vehicle, then move your money to the growth plan.
Okay. Growth is a buzzword, okay? Subramaniam says, does the dividend declared and added to dividend reinvestment option also subject to dividend distribution tax?
Yes, because it's real dividend, and you have chosen to reinvest in the fund, so it is subject to dividend distribution tax. And in the earlier question, we answered that it is particularly no way it benefits you. Move your money to the growth plan. This will hurt your interest.
Okay. Venkat Krishnan says, which is better, an arbitrage fund or an equity income fund for short-term goals for less than 3 years? Should I invest through SIP or lump sum?
Both these vehicles, they are different kind of funds. Arbitrage fund, I would say that they're somewhat like a liquid fund, except that tax treatment will be like that of an equity. So if your investment time frame is between 1 and 3 years, then maybe arbitrage works better than a liquid fund, because it will be subject to 10% tax rate only. Whatever be the appreciation, pay 10% of the gains and you are done. In case of liquid fund, if it is going to be 1 to 3 years, all the gains will be added to your income. If you are in the higher tax bracket, 30% or 20%, then it will be, and I don't visualize that arbitrage funds are likely to give any more return than liquid funds, given the amount of money that has flowed in, and arbitrage by its very nature is self-cannibalizing. So short-term parking vehicle, these are the vehicles, liquid funds or ultra short-term bond fund, or maybe a short-term bond fund. Equity income fund is a conservative allocation. A third of this money is getting invested in equity, and a third of this money is getting invested in arbitrage opportunity, and another third is getting invested in fixed income, and tax treatment is like that of an equity. So from that standpoint, I would say that it's a different vehicle. It is a vehicle to optimize return. If your time frame is 3 years and less, I would say consider short-term bond fund, even arbitrage fund as a conservative vehicle for a more tax efficient vehicle. Equity income fund might translate into, in the worst case scenario, can also translate into zero return for you.
Okay. Moving on, Mukesh says, I'm a senior citizen relying on FD interest for day-to-day expenses. Is it advisable to switch to balanced funds?
They're very different. Balanced fund is almost like an equity fund. Just 2/3 of the money is invested in equity. And if you are heavily dependent on that, and if it is large amount of money, I would say the thumb rule which I follow is that if you are withdrawing anywhere between, if your need for income from your capital can be managed or can be met with 5% withdrawal rate. For example, if you have 1 crore of rupees of deposit, and if you can manage with about 40,000 rupees monthly income, which is about nearly close to 5 lakh rupees annual, 5 to 6% annual withdrawal rate, I think balanced fund will turn out to be very efficient. It will be tax efficient. It will also have the potential to appreciate. It will have the potential to increase your income over time. But this 5 to 6% is very important. If you start withdrawing 10% of this money, it will become very risky, because in a bad market, in a bad situation, you would have consumed a large part of your capital. So this withdrawal rate is crucial. Never exceed more than 6%, and then balanced fund will work. If you exceed that thing, exceed more than 6%, it will be injurious. And anyway, compared to fixed deposit, these vehicles are more tax efficient. But it is not easy for me saying so, because somebody who has not been used to the ups and downs of the market, who has not seen that appreciation, and who remains disciplined. But if you are able to do that, so if you have sizable money and if you want to grow your money with time, FD, balanced fund could be an option. But fixed deposit, you have to look for some more conservative vehicle, not necessarily balanced fund, maybe an equity income fund. Even a debt fund will translate into superior return.
Okay.
Because but the conservative ones, not the dynamic bond fund or funds which actually take a bet on the interest rate or credit exposure, but relatively stable, because the form in which you get the return in case of a debt fund is far more tax efficient. They are liquid. They are also able to diversify the risk. When I'm looking at the changing risk complexion of the fixed deposit investor, the way the banks are conducting themselves, the kind of risk one is exposed to, but one is not acknowledging it. Mutual funds actually present you an opportunity to diversify your risk, where all your money will not be exposed to some bad credit happens.
Okay. We have this question from Ramesh. He says some funds are holding up cash awaiting trade war results. Should I do the same?
I really wonder some fund is doing it and they will succeed. I have seen in the last 25-26 years that fund managers who have attempted to time either a trade war or awaiting a correction or waiting a overheated market, nobody has been able to call it right. They lose patience. Sometimes they are right, but many a times they are also wrong. Sometimes if you are right after 2-3 years, you have lost a big opportunity too, waiting for that correction which happens, but meanwhile you have remained 30% cash. And as an individual, so professional managers fail in calling the market. You don't attempt that.
And you always say one should not be timing the market.
One should not be timing that, and professional managers fail in doing so. Right. So individuals should not even think of doing it, and in fact that turns out to be one of the biggest advantage of an individual investor. Your ability to average investments over time with ups and downs, that itself contributes heavily to your relative well-being as compared to many funds. Right. If you look at long-term performance of if you look at 10-year point-to-point return over time as compared to 10-year SIP return for most investors, the way we actually invest, it turns out to be far greater for that regular investor than the person who has attempted it.
Let's move on. Naresh says, my dad is a senior citizen and wants to get a monthly income of 15,000 to 18,000 by investing rupees 20 lakhs in mutual funds. Is it possible?
It is possible, but it will come with a lot of ups and downs. And this 15,000 rupees, just think of it in a very, doing the basic maths. 15,000 rupees is 1.8 lakh rupees per annum. And on 20 lakh rupees capital, this translates into a 9% return. Earning 9% return from mutual fund, from a relatively conservative mutual fund, maybe the mutual fund, the MIPs, monthly income plans, the growth option, and a withdrawal rate of 9% might, most funds will actually produce this kind of, would have produced this kind of return over the last 8-10 years. But sometimes they won't. So it is possible. And in fact, that is the only way, because if you take it in the form of if you make a deposit or buy a bond or buy a bond fund, the returns will be taxable. It will be treated as income in case of fixed deposit and bonds. It may be converted into a capital gains if you invest in a bond fund, but it will not produce these returns. There is also you will also have one more need, that if you are earning 9%, and the capital also needs to grow, because if your father needs to earn 15,000 a month this year, then next year his need will be 16,000 rupees with rising inflation. So the capital also needs to grow. So for that he will have to assume a slightly higher risk. Maybe the equity income funds, which invest a third of that, and and in the initial years have a lower withdrawal rate, maybe a 8% withdrawal rate. So that will be about 14,000 rupees a month. It will translate into close to 14,000 rupees a month. And after that, as your capital grows, over time, maybe revise it every 2 years. That way, and that is actually that's the only solution for ensuring inflation adjusted income for senior citizens.
Maya Shankar writes, what do mutual fund houses do with the dividend received from the shares they hold? Do they purchase some more shares of the company they already have, or invest in some different companies?
They get money. Mutual fund companies are getting money from 3 sources all the time, and they invest in the best ideas that prevail, the best ideas that exist then. Mutual fund companies are getting money from new investors. They are getting money by booking profit on their existing investments, and they are getting money from any dividend which any of their existing investments might be giving. So all this money, assuming that in the evening, and after adjusting it for all the redemption that any investor would have requested, all that money gets into the best idea that is in the mind of from a view of a fund manager. It could be an existing company, it could be a new position, it could be a small position in the portfolio. So depends his priority.
Okay. I have rupees 25 lakhs invested in short-term debt fund, writes Anoop, and I plan to withdraw 8% of the principal every year. Will I be liable to pay short-term capital gains tax on the whole withdrawal of 8%?
No, that is the beauty of mutual fund. Your 8% withdrawal rate, if you are actually taking the money out in the form of a withdrawal, assuming you have invested 1 crore of rupees and you take out 8 lakh rupees in a year, then a good part of this withdrawal is taking your capital. Only on the units that you will be redeeming worth 8 lakh rupees, the gain component on those units will be liable for short-term capital gains.
Right.
So, because you are taking your capital back, it's not a gain. Because remaining money, which is the 2 lakh rupees which remains invested, the appreciation on that remains with those units, because the accounting of mutual fund is done like this. You are taking the units back, you are redeeming your units, you are taking accounting the accounting unit is accounting form of a mutual fund is unit. So you are redeeming, so of this 8 lakh rupees, you have taken a part of your, you have redeemed your units. Only the gain component on those unit is worth 8 lakh rupees. So of that 8%, assuming that the whole money, so it will be very insignificant. You will not be liable for capital gains, short-term capital gains on the whole 8%, but it will be maybe the 7-8% appreciation on those units. So nearly 90% of your investments will be tax-free. It will be treated as taking your capital back. Only a small part, nearly 10% of it will be considered as gains on which you'll be liable for taxes.
Okay. Last question of today's episode. Writes Meenakshi, I'm 49. I lost my job and will soon look for another one or start my business. I will receive 40 lakhs as benefits. I already have 1.2 crore in PPF and EPF. How can I generate a monthly income of rupees 50,000 for my expenses and another 40,000 for my SIPs? Is it advisable to withdraw PPF?
Yes, it is advisable to withdraw PPF if you are going to be disciplined. If you take your money out from PPF and EPF and invest for the long term, and your income requirement is very small. If I look at this capital of 1.2 crore and 40 lakh rupees additional she'll be getting. So you will end up with 1.6 crore. If this is your corpus, assuming that this is your retirement corpus and you derive income from it, and your income requirement is 50,000 rupees a month, which is about 6 lakh rupees a year, which is insignificant. Is about 4%, close to 4% of your
1.4.
Of 1.6 crore. This is nothing much. 4% is 4% withdrawal rate is a very safe withdrawal rate, and it's a good idea. And this will also ensure that next year, instead of 50,000 rupees a month, you need 55,000 rupees a month. You will have the capital. At least every 2-3 years, you can revise your income from this investment. So your capital grows, your income grows, and if you don't do it, your money remains constant. It will just barely be matching inflation, and if you consume all the returns on your investment, your capital remains constant, which is not a good idea.
Okay. Thank you so much, Dhiren.
Thank you
for answering all the queries of our viewers. That's all we have in today's program. Till we meet next time, remember, Dhiren said growth is what you have to look at. Take care of
option.
The great growth option of mutual funds is what you have to look at. That's all. Stay invested. Goodbye for now.